Is the golden glow of gold prices starting to dim? Traders are on edge as mounting downward pressure threatens to push the XAU/USD pair toward its crucial 50-day support level. Stay tuned to find out why this could mark a pivotal moment for precious metals enthusiasts. Yet, before we dive deeper into the gloom, let's explore a silver lining. There's still room for optimism with a possible rebound in sight. If the low point from Tuesday at $3,886 manages to hold firm as a support base, we might see a rally testing resistance around the 20-day moving average at $4,072. For those new to trading, a moving average is like a smoothed-out average of past prices over a set period, helping to identify trends. Here, it acts as a hurdle that price needs to overcome. Pushing above today's peak of $4,030 would signal that an upward push toward that 20-day line is underway. Today's quick foray into a daily bullish reversal represents the first significant dip to challenge the 20-day average since Monday's aggressive sell-off, which wrapped up weekly near the session's bottom. But here's where it gets controversial. Some analysts might argue that this breakdown isn't as ominous as it seems, perhaps dismissing it as a temporary hiccup in a bull market. After all, gold has historically bounced back from such moves, right? And this is the part most people miss, the true power of Monday's downturn. It didn't just dip under the 20-day moving average. It shattered the top boundary of an ascending channel pattern, with both lines nearly overlapping on the very day of the breach. For beginners, an ascending channel is a trend where price oscillates between parallel rising lines, like a corridor guiding the action. This double failure packs a serious punch, amplifying the bearish signal. Now that support at the channel's upper edge has crumbled, the pattern's lower side emerges as a probable destination, though the dashed midline, think of it as the channel's central guide, is more likely to face testing first before the adjustment wraps up. Shifting gears to the downside targets, an early landing spot for gold lies at the 50-day moving average, currently sitting at $3,794. As this average climbs, it will soon align with the 50% Fibonacci retracement level at $3,846, creating a combined zone of potential support amid this ongoing bearish pullback. Fibonacci retracements are based on mathematical ratios from the Fibonacci sequence, used to pinpoint likely reversal points after a big move. For example, after a strong rally, the 50% level often attracts buyers looking to re-enter. Traders might capitalize on any surges into this resistance turn support area by liquidating their long bets or jumping into short positions, fueling the continued descent until proven support demonstrates its resilience. Peering into the outlook and pivotal markers, a closure beneath $3,916 will be telling. Dropping lower aims straight for the channel's midline and that $3,794 to $3,846 support cluster, whereas staying above defends the $3,886 low. The 20-day average at $4,072 acts as a ceiling for short-term recoveries, but the channel's mechanics lean heavily toward eventually probing the midline, or at least getting uncomfortably close. Keep a close eye on how price behaves at these supports. Defending the 50-day average preserves the overarching upward trajectory, while a decisive plunge hints at a lengthier and more intense downturn. Today's market movements bolster the bearish slant until purchasers display unwavering resolve. For a complete rundown of today's financial happenings, don't forget to browse our economic calendar at https://www.fxempire.com/tools/economic-calendar. What do you think? Will gold defy the odds and stage a comeback? Or is this the start of a prolonged slump? Is the channel breakdown overblown, or a clear warning sign? Share your perspectives in the comments below. I'd love to hear if you agree, disagree, or have a different take on where gold is headed next.